Welcome to the deep dive. You know, building wealth often feels, well, incredibly complex, doesn't it?
It really does. So much noise out there.
Exactly. So instead of wading through all that, today we're going to unpack something much simpler, but really powerful. It's the 7531 rule for systematic investment plans, SIPs.
Mm-hmm.
This comes from Aditya Roy. And really, our mission today is just to give you a clear shortcut, actionable guidelines for wealth building.
Right. We're aiming to pull out the absolute key insights from Roy's framework in this deep dive. So it's not just understanding what the rule is, but really why each part matters for your own financial journey. You should leave with some practical takeaways.
Perfect. Let's start with the first number then.
Yeah.
7. Okay, let's unpack this. What does 7 signify here?
So 7, the article really hammers this home. It's about a minimum time horizon of 7 years for equity investments.
7 years minimum,
Yeah.
okay?
Yeah, and the why is fascinating. It genuinely gives your investments the breathing room they need to grow. And just as importantly, it helps you kind of ride out the inevitable short-term market bumps, volatility.
Makes sense. Equity markets need time to recover and show returns, right?
Precisely.
Yeah.
History shows that over those sorts of rolling periods, like 5-7 years, markets tend to deliver. It reduces that short-term risk. And there's a nuance, too. It advises an even longer horizon if you're looking at small-cap or mid-cap funds.
Because they're typically more volatile. Higher risk, higher potential reward, but needs more time.
Exactly. More risk baked in there, so more time helps smooth things out.
Okay, so 7 years minimum sets the stage. What's next? The 5 FET. It sounds like it's about building the actual portfolio.
You got it. 5. The core advice here is to limit your portfolio to about 5 different categories of equity funds.
5 categories. Not 5 funds necessarily, but 5 types.
Right. The idea is to get broad market exposure. Think diversified funds like multi-cap or flexi-cap. They invest across different company sizes. This helps avoid getting, well, diversified, having too many funds that it just gets messy and might even dilute your returns.
Diversification, I like that. Spreading yourself too thin almost.
Kind of, yeah. 5 categories gives you good diversification without making it unmanageable. And importantly, what to maybe steer clear of, especially if you're newer to investing.
Let me guess. Those really niche funds.
Spot on. The guidance suggests avoiding sectoral or thematic funds. They focus on very specific industries or trends, which ramps up the risk considerably.
Got it. Keep it broad, keep it manageable. 5 categories. Okay, moving on to 3 fund. This sounds less about numbers, more about mindset.
Absolutely. Investing isn't just spreadsheets, it's psychology. The 3 foot tackles the 3 big psychological hurdles investors face.
Which are? I can probably guess a couple.
Disappointment, frustration, and panic.
Yes. Disappointment when things dip, frustration when growth feels slow, panic when the market crashes.
Exactly. And the rule gives guidance on pushing through these. It's about discipline, really. So when you feel disappointed after a loss, the idea is to reassess your reasoning, not just quit.
Right, don't make emotional decisions.
And frustration, that needs patience. You have to let compounding do its thing. It's a marathon, not a sprint.
Mm-hmm. Compounding needs time.
And panic. Well, resisting that urge to sell everything during a crash is crucial. Stick to the plan. It's about perspective when things feel chaotic.
Maintain perspective.
Oh.
Okay, that's huge. So we've covered time, diversification, and emotional strength. The final number is 1. What's the 1 about? Actively growing things.
Precisely. This is about turbocharging your growth. The guideline encourages you to step up your SIP amount once a year.
Like an annual increase as your income hopefully goes up.
Exactly. Even a small increase makes a massive difference over the long haul. The article actually shows an example, just a 10% annual step up in your monthly SIP. Over 20 years, that can mean your final pot of money is maybe 30% to 50% larger.
Wow, just from that one small action each year.
Yeah, compared to just keeping the SIP amount flat, it's the power of compounding working on ever larger amounts. It's a real game changer for long-term wealth.
That's incredibly powerful. So the 7531 rule, it really does distill a lot of investing wisdom into a simple, actionable roadmap for you, doesn't it?
It really does. Simple structure.
And the article also mentioned for anyone needing a bit more help, maybe building that portfolio or navigating the emotional side, Value Research Fund Advisor is a resource they recommend.
Yes, that's noted as a potential support.
So wrapping up, think about how these 4 simple numbers, 7531, managed to cut through so much complexity.
It's quite elegant, isn't it? How simplicity, applied consistently, can be such a powerful engine for wealth creation, especially with all the market noise trying to distract you, maybe something for you to reflect on. How do you balance having a clear structure, like this rule, with the need to adapt in your own financial planning? Where's that sweet spot for you?